Okay, so let's unpack this. It is Monday, February 23, 2026. And if you are anywhere near the Mid-Atlantic, so Virginia, the Carolinas, or frankly, if you use the internet at all, what we are talking about today affects you directly.
It absolutely does. I
Yeah.
mean, we are really talking about the invisible backbone of the modern economy here.
We are talking about Dominion Energy. And look, I know what you're thinking. You're thinking, a utility company earnings report. Did I click the wrong deep dive? But stick with me here.
Yeah, please stick around, because it is wild.
Right, because this morning, Dominion dropped their fourth quarter and full year 2025 earnings. And this isn't just about, spreadsheets and accounting.
Yeah, not even close.
It's a story about this massive entity trying to pivot from the old world of coal and gas to a completely new world of offshore wind and AI data centers, all while trying to keep the lights on and keep the shareholders happy. And looking at these documents, it is messy.
It is incredibly messy, but that messiness is exactly where the interesting stuff is hiding. If you just read the headlines, you completely miss the actual story of what's happening to the energy grid right now.
So here is our mission for this deep dive. We are going to look under the hood of these financial results. We've got the press release, we've got the really messy financial schedules, specifically Schedule 1 through 4.
Oh yeah, Schedule 2 is a beast.
It really is. And we have their forward-looking guidance. So we need to figure out, is this company actually making money selling electricity? Or are they just juggling tax credits and stock market gains?
And critically, are they actually ready for the massive demand spike that's coming from all the data centers right in their backyard?
Right. So let's start with the big reveal. 2025 is officially in the books. How did they do?
On paper.
Yeah.
They had a fantastic year. It was a huge rebound year.
Give us the headline numbers.
Okay, so for the full year 2025, Dominion reported GAAP net income of $3.45 per share. If you want the total dollar amount, that is roughly $3.0 billion in profit.
Okay, $3 billion. That sounds like a lot of money. How does that compare to 2024?
It is a massive jump because in 2024, that number was $2.33 per share, or roughly 2.0 billion. So strictly speaking, their reported net income went up by $1 billion year over year.
Wow.
Yeah, that is a 50% increase. And just for a quick Q4 snapshot, the quarter ending December 31st, GAAP was 65 cents per share versus 14 cents in Q4 of 2024. So a huge finish to the year.
See, if I'm a casual investor or if I'm just skimming the news, I'm thinking, wow, they must be selling a lot more electricity. Champagne for everyone.
We'll put the champagne back on ice for a second.
Okay, holding the champagne.
Because this is where we have to put on our detective hats.
Yeah.
That number I just gave you, the $3.45, that is the GAAP number.
Yeah.
Generally accepted accounting principles.
All right, the official scorecard.
Exactly. But if you talk to Dominion's management or the Wall Street analysts covering them, they are looking at a completely different metric called operating earnings.
I saw this in the release. They listed operating earnings at $3.42 per share for the year, and Q4 was 68 cents.
Right. And here's the weird part for 2025. Those two full-year numbers are almost identical.
Yeah, $3.45 versus $3.42.
Usually there is a huge gap between them.
So does that mean the accounting was just really simple this year?
No, quite the opposite, actually. The fact that they are similar is a total coincidence. They arrived at those two numbers from completely different directions, with these massive swings basically canceling each other out.
Okay, let's dig into that, because I was looking at Schedule 2 in the report, which is labeled Reconciliation of Measures, and it looks like a crime scene of red and black ink.
Schedule 2 is the Rosetta Stone here. It explains the difference between that official GAAP income and the operating income. Because management uses operating earnings to strip out the volatile one-time things so investors can see the fundamental power of the business.
Right.
And the story of 2025 is really the story of two massive line items on that schedule fighting each other.
Well, the first one I circled was the Nuclear Decommissioning Trusts, the NDT. It says there was a $507 million net market benefit.
Yes. This is a huge number. $500 million.
Explain this to me like I'm 5. Why does a trust fund for closing down nuclear plants make it look like they earned an extra $500 million?
Okay, so Dominion owns nuclear power plants, right? North Anna, Surrey, Millstone. Someday, decades from now, those plants will have to shut down, and it costs us an absolute fortune to take apart a nuclear plant safely. You can't just, lock the door and walk away.
Right, you have to deal with the radiation, the waste, securing the site.
Exactly. So regulations require them to set aside money right now into a trust fund to pay for that cleanup later. and that money is invested in the stock market.
Oh, I see where this is going.
Yeah, accounting rules say that if the stock market goes up, and 2025 was generally a very good year for the markets, Dominion has to record those gains in that trust fund as income.
But can they spend it? I mean, can they use that $507 million to pay dividends or build new stuff?
No, that is the kicker. It is strictly ring-fenced for decommissioning. So GAAP says, congrats, you made $507 million. But for the actual day-to-day business operation, that money might as well be on the moon.
So that explains why the gap number is so high. It's basically a reflection of Wall Street having a good year, not necessarily the power grid having a good year.
Precisely. And in 2024, the exact opposite happened. The markets were choppier, so they took a massive loss on paper. That's why the gap number swings wildly year to year while the operating number tries to stay smooth.
Okay, so the stock market gave them a $500 million boost. But then I look a few lines down on Schedule 2 and I see the exact opposite happening, a massive negative number.
The charge for the offshore wind project.
Right, Coastal Virginia Offshore Wind, CVOW. There is a charge here for $258 million, and the description is, well, it's concerning. Regulated asset retirements and other charges.
Yeah, look at the fine print underneath that.
Yeah, it says costs not expected to be recovered from customers.
That is the phrase that keeps utility executives up at night. See, the deal with a regulated utility is usually pretty sweet. You spend money to build infrastructure, you show the receipts to the government regulators, and they allow you to add that cost to the customer's bill, plus a guaranteed profit.
It's a cost-plus business model?
Usually. But regulators don't approve everything. If they decide a cost was imprudent, or if the specific legislation for a project puts a cap on costs, the shareholders have to eat the difference.
So this $258 million, this is money Dominion spent on the wind project, maybe on parts that broke or plans that change, and they are realizing we are never getting this money back.
Exactly. It's a $250 million hole in their pocket.
Yeah.
And it really highlights the financial risks of these mega projects. Everyone talks about the energy transition like it's just a matter of swapping out coal plants for wind turbines. But CVOW is a massive construction site in the middle of the Atlantic Ocean. Things go wrong.
It's a harsh reality check.
It is. And it's a perfect counterweight to the NDT gains. So you have a $507 million paper gain from the stock market, masking a $258 million real loss on the wind project.
Plus a few other adjustments, right? Like there is a $131 million benefit on pension plans, but a $153 million hit from economic hedging.
Right, all that noise. And when you strip all of it out, you land on that operating earnings number of $3.42.
Management says reflects the actual health of the business.
Right, and that $3.42 is actually a very solid number because it's up from $2.77 in 2024. So despite all the messiness in the accounting, the core business actually grew significantly.
So let's pivot to that. If the operating earnings is the real number, where did the money actually come from? Because Schedule 1 breaks this down by segment. And looking at it, it seems like Virginia is doing all the heavy lifting here.
Virginia is absolutely the star of the show. The segment is Dominion Energy Virginia, or DEV. Operating earnings there jumped by $314 million compared to last year.
That is huge growth for a utility. I mean, usually these things move by pennies.
Yeah.
What drove that?
Two main things. First, something called rider equity return. That contributed a massive $507 million increase.
Okay, rider equity return. That sounds like jargon perfectly designed to make my eyes glaze over. Translate that for us.
It really does. Okay, think of a rider as a separate line item on your electric bill. It's usually tied to a specific project, like grid modernization or burying power lines.
Oh, I've definitely seen those on my bill.
Right. So when Dominion spends $1 billion burying lines, they don't just get that money back. They get the money back plus an equity return, which is basically a profit margin authorized by the state.
So when we see that number jump by $507 million, it essentially means they finished a lot of construction projects and started collecting the rent on them.
Exactly. They poured the concrete, they hung the wires, the projects went in service, and the cash register started ringing. It shows that their strategy of heavy capital investment in Virginia is really paying off.
But it wasn't just that they built stuff. I saw another line item that surprised me, customer usage.
Yes. This added $173 million to the bottom line.
And that's surprising because for years we heard that electricity demand was flat. People were buying LED bulbs, appliances were getting efficient, we were supposedly using less power even as the population grew.
Yeah, that era is over. We are seeing real load growth again. Part of it is electrification, people buying EVs, heat pumps. But a huge part of it is the economy in Virginia just running hotter. More businesses, more homes. Oh, and weather was a mild positive factor too, adding about 18 million.
And we'll get to the biggest driver of that usage of growth data centers in a minute. But first, let's look at the other segments. Contracted energy. This is where the Millstone nuclear plant in Connecticut lives. It was up 79 million for the year.
It was. But the story here isn't really about selling power. It's about taxes.
Ah, the green bonus.
Essentially, look at the breakdown. Renewable Energy Investment Tax Credits, the ITCs, increased by $63 million. Production tax credits, PTCs, increased by $91 million.
Wait, so that's over $150 million of increased earnings just from tax credits.
Yes. This is the clean energy transition playing out on a balance sheet. The federal incentives are effectively paying Dominion to build and operate clean energy.
It's wild when you think about it. The profitability of the segment is almost entirely dependent on federal policy.
It connects directly to the business case for renewables. Solar and wind are great, but the tax credits are what make the margins attractive for a company like this. Without those credits, this segment would look very, very different.
Especially since they mentioned some outage costs at Millstone.
Right. They had a mixed bag there, some planned outages that cost money, plus some unplanned outage impacts. But the tax credits more than wipe that out. It's a great example of how government incentives are acting as a buffer for these companies.
Then we have South Carolina. Steady growth there, up 137 million.
South Carolina is your classic bread and butter utility story. 127 million of that increase came from base and RSA rate case impacts.
Which is a polite way of saying they raised the rates.
Correct. They went to the regulators, argued that their costs has gone up, and got approval to charge more. It's not flashy like the offshore wind stuff, but it is the absolute foundation of their cash flow.
So Virginia is booming with new projects. The contracted fleet is cashing tax credit checks. South Carolina is raising rates. Is anything dragging them down?
The corporate and other segment. It is almost always a drag on earnings, specifically because of interest expense volatility, though it did improve slightly in Q4.
Right, interest rates.
Dominion carries a lot of debt. You don't build a $10 billion wind farm with cash from your checking account. You borrow it. And servicing that mountain of debt is expensive.
It's like having a really big mortgage. Even if you get a raise at work, that monthly payment is still taking a huge chunk of your paycheck.
Exactly. And until they pay that down, it's going to continue to be a headwind.
So that's the snapshot of 2025. A noisy, messy, but ultimately profitable year. Now, let's look forward. They released guidance for 2026. What are they promising?
They are projecting operating earnings between $3.45 and $3.69 per share. The midpoint is $3.57.
So coming off of $3.42 in 2025, they are guiding to $3.57. That is, well, it's steady.
It is steady. It falls right into their long-term promise of 5 to 7% annual growth. They're trying to be boringly predictable, which is exactly what utility investors want. Oh, and they confirmed the safety of their existing dividend guidance, too.
But you found a little nugget in that guidance that wasn't boring.
I did. In the specific callouts for the 2026 guidance, they explicitly list a contribution of 7 cents per share from RNG 45Z income.
RNG 45Z. It sounds like a secret agent or a droid.
It does. It stands for renewable natural gas, capturing methane from agriculture or landfills. And 45Z is the section of the tax code for the clean fuel production credit.
So they are telling us that 7 cents of their earnings per share is coming from this one specific tax credit starting in 2026, which shows how policy directly impacts the bottom line.
Yes, just reinforces the point. Their growth strategy is tightly coupled with tax incentives.
And looking further out, they reaffirmed that 5 to 7% growth rate through 2030. But there was a nuance there. They explicitly stated a bias to the upper half of that growth range for the years 2028 to 2030. What does that imply?
Bias to the upper half. That is corporate speak for swagger.
Like, we aren't just going to hit the target, we're going to crush it.
It implies a lot of confidence. They are suggesting to investors that all these long-term capital investments they're making right now, which are expensive and risky, are going to pay off in a big way later the decade.
They see the light at the end of the tunnel.
They do. But, and there is always a but, we have to look at the risks, because the path to 2030 is not a straight line.
Oh, the forward-looking statements section of the press release. My favorite part is where the lawyers list everything that could possibly destroy the company. And this year, there was one phrase that stood out like a neon sign.
Data centers.
Specifically, they warned about significant accelerated growth in demand due to new data centers, and they explicitly named Loudoun County, Virginia.
We have to talk about this. Loudoun County is known as Data Center Alley. A massive percentage of the world's internet traffic flows through there.
And this connects right back to that customer usage growth we mentioned earlier. It's not just people turning on lights, it's the internet living in Virginia. And now with AI, those data centers are changing. They're training massive models, which requires an insane amount of electricity.
It does. And for a utility, this is a double-edged sword. On one hand, it's a massive opportunity. You have a customer with an infinite appetite for your product.
Right. But on the other hand,
You have to actually deliver the power. And that is the bottleneck. Building a data center takes maybe 18 months. Building the transmission lines and substations to power it, that can take years.
because you have to get permits, you have to fight lawsuits, you have to acquire land.
Exactly. If they can't build the infrastructure fast enough, they can't serve the load.
It's a race. The tech companies are sprinting, and the utility is trying to run in heavy boots.
And to try and win that race, Dominion is looking at some clean tech that feels, well, a bit sci-fi. Did you see the list of technologies they're watching?
I did. Large-scale battery storage, carbon capture, hydrogen, and SMR's small modular reactors.
These aren't just buzzwords. The company lists the technological and economic feasibility of these as a specific risk factor.
Meaning the transition path isn't guaranteed. They are saying, we might need these small modular reactors to keep the internet running, but we honestly don't know if they work at scale or if we can afford them.
Essentially, yes. If SMRs turn out to be harder to build than expected, it's a huge problem.
And speaking of risks, we can't ignore the perennial ones. Extreme weather events and getting regulatory approvals.
Always. With the coastal Virginia offshore wind project, weather takes on a scary new meaning. You are building huge turbines out in the ocean.
In hurricane territory.
Right. If a major storm sweeps up the Atlantic coast during construction, you get delays, damage, cost overruns. That $258 million charge we saw this year, that could look like pocket change if a severe hurricane moves through the construction zone.
It really emphasizes how exposed this business is to the physical world. They can do all the financial engineering they want, but at the end of the day, they have billions of dollars of steel sitting in the ocean.
That is the fundamental tension here. Dominion is a financial powerhouse navigating tax codes, but they are also an infrastructure company battling the elements.
So let's pull this all together. 2025 was a strong rebound year, despite the messy accounting. Virginia is clearly the growth engine.
That's the summary. They are successfully deploying capital in Virginia. Renewable tax credits are boosting the bottom line, and they are betting heavily on the upper end of their growth targets for the late 2020s.
Why this matters to you, the listener, is that Dominion is really a microcosm of the entire energy grid right now. They are balancing legacy nuclear and gas with massive offshore wind investments, all while dealing with explosive data center demand.
It is the ultimate juggling act.
Here's the thought I want to leave you with. We spent time talking about that $258 million charge on offshore wind money that just evaporated, but we also saw huge gains from green tax credits, plus that new RNG 45Z credit coming next year, and then that bias to the upper half in 2028.
Right.
The question is the energy transition finally becoming a profit engine rather than just a cost center? Or does that massive write-off on the wind project remind us that building the future is still incredibly expensive and risky?
That is the multi-billion-dollar question. They clearly think the profits will outweigh the risks long-term, but the ocean and the policymakers might have the final say.
We'll be watching the riders, the tax codes, and the storm clouds. That's it for this deep dive into Dominion's 2025 results.
Thanks for listening. Catch you on the next one.